what are just the main benefits of investing in real estate for a passive investor? Just anyone that buys real estate, can you just give us a broad concept of what are some of those tax benefits anyone and everyone gets just from owning real estate?
Real estate for us is fascinating. Lorraine and I have been real estate investors since 1993. And we were just talking before the show broadcast. We remember in 1993 dragging our little children to our first rental property and scraping the wallpaper off of the wall. Okay. We've been at this a long time, and we've learned from personal experience as well as professional some of the benefits of real estate. First, if you invest in real estate, you're investing in an asset class that has a tendency to keep pace with inflation. It grows.
And right now, inflation as of the end of March is at 8.3%.
Yikes. The second thing that
Absolutely.
we know about real estate is we want our real estate to produce rental income, right? Cash flow. And here's a brilliant thing about rental income from real estate. It is offset by a thing the IRS defines as depreciation. And let me define depreciation for a minute. If anybody's been a real estate investor for a while, carpet doesn't last 27 and a half years. Although we've seen properties where the people thought the carpet lasted for 27 and a half years, the IRS actually allows those things to be depreciated or expensed against rent. So when you buy a piece of real estate, you have depreciation, it offsets your rent. Now, for the average Joe, without any special approaches, no real estate professional status, none of that stuff, your rent is offset by depreciation, making your rent, to the extent you have that expense, tax-free.
Tax-free.
Wait a minute. Can you say that again?
Tax-free.
I love it when she talks like that. I just do.
I mean, that means in theory, if you had $3,000 of annual income through rent, that could be equivalent of $5,000 or potentially, depending on your tax bracket, $6,000 in some places of the country that would otherwise be subject to. I mean, we have depreciation, and then we have all sorts of other expenses and write-offs just the average person gets as well, right?
Absolutely.
Yeah.
One of the things that's really cool about real estate is it goes up in value. But you'll notice you don't pay tax annually on the increase in value of your real estate. That's called deferred tax. So you only pay that tax when you sell the real estate later on.
Unless you do a 1031.
Right.
So,
right.
yeah. So
we'll talk about
so it
gains
is
in a minute.
tax-free income, right? Tax deferral on the growth. And then depending, and Jim said something interesting. He said professional real estate status, which we could go into later. To simplify that, real estate is passive. It's a passive investment. For most people who are W-2 working full-time, it is passive. So there are some limitations. Now, we'll talk later about RE Pro status, and that is having the real estate active. So active is you're physically working in the business like you would work in any other business. And in that case, your deductions are unlimited.
And you can actually write that off against your active income if you have income or have a spouse that has income. I mean, that's one of the other bullet points that we're going to get through. So, but just in general, John Doe buys his first rental property. Fantastic. He gets tax-free income. He gets depreciation offset the active income. Other things he can write off, his mortgage interest, right? That's on his 1098-T, I believe it is. What about tax and insurance? What about closing costs for that? What about setting up that LLC? What about your management expense? I mean, all those things are also deductions, right? So you should be, in my opinion, reporting a loss in a lot of cases on these properties, even though they're producing active income. Would you agree?
Now you're getting technical.
That's what
you can literally have losses on your real estate, even though you are making positive cash flow with your real estate. Okay. So we want you to know that when we're talking losses, these are paper losses, not actual honest to God out of your pocket losses. If you're buying the right real estate,
which you are with rent to retirement.
Now, one of the things that you said is writing a whole bunch of stuff off. One of my favorite little techniques, imagine for a minute that you buy a couple of pieces of real estate, and you've got nice rental income coming through there, and you love your children and you want to save money for your children's college, your real estate operation can pay your kids on payroll. Because they have payroll, they can then qualify for a Roth IRA. Mind blowing, available tax free, available for higher education, tax deductible for mom and dad against those rents, right?
And tax-free income for the kids up to $12,000.
Specifically, because it's a Schedule E activity, in other words, it's a disregarded entity if you own your LLCs and such. Specifically, there's no self-employment tax for the children. The IRS knows all about this. They want you to put your kids on payroll.
So I think that's something that just sparks a lot of people's interest. But let's try it without, and that's the goal of today. Today we're going to cover a lot of high-level topics that we will be breaking down on future shows in more greater detail. And obviously, if people are interested to go through their individual plan with each of you, they would schedule the time to do that.
Right.
But I mean, Adam has 11 children, and I think he's very interested in setting this up. This is going to be paramount for him. Can we just talk a little bit more in greater detail about doing that? Are we talking about child labor, where the kids are going to be managing the properties?
Right.
Let's talk more about that.
Let me answer that. So, what we do in the implementation process. So, let's say we're sitting down with somebody, and let's say Adam. We're saying,
children.
Okay, 11 children. Okay, what's their ages? What job description do they have? You have to have a job description. And what are the hours and what is the pay? So people ask us a lot of times, well, I have, a little baby. So maybe their baby is Johnny. So they name their business Johnny Properties, and they take a picture, or they take a family picture with their kids. You see it all the time with dentists, law firms, family law. You see pictures of the entire family. Well, they're paying their family, their kids, for that marketing. And so that might be, $6,000, $8,000, whatever the market rate is in that area. And then that child gets that income, and that is 100% deductible against the real estate business, the LLC. And then the child has zero tax on that.
So what are the actual, that's obviously something you could do with your kids, but if I actually wanted my kids to work in the business, what am I allowed to have them do now? If I have, so I have property managers. I only have 4 kids. Thank you very much, Zach. But,
just feels like there's 11 of them.
It definitely can. So, I've got 2 7-year-olds, a 9-year-old, and an 11-year-old. What kind of actual work and am I allowed to say, like Zach said, I don't want to run into child labor laws, so I'm not going to have them going out. I have property managers. My properties are far away. What can I actually have them do?
Okay. Well, we have to understand that the job description, from a tax perspective, the job description has to be something they're capable of doing. One of my favorite stories, I had a grandma and grandpa, and they hired their 5-year-old adorable grandson to do shredding, like, take papers and put it in the shredder. Well, at 5 years old, he was fascinated by this. He kept putting the paper in the shredder, and he did a great job of shredding until after he ran out of everything to shred, he started to get creative to trying to find other things to shred. Grandma and grandpa are like, no. As long as they're capable of doing the job, they're okay.
So kids,
as far as child labor laws are concerned, there's federal laws and state laws. That's not our expertise. However, if you think part-time work, the IRS, pretty much everybody's going to leave you alone.
So it might be something where a 7-year-old may, their kids nowadays, they're amazing on the internet. They may want to look at properties. You could teach them how to analyze the properties. You can, have them throw the trash. You can have them do different chores. What would you hire somebody else to do? It's like, what would you hire somebody else to do? So what we do is we have actual package forms. So in the forms, we have an employment agreement for the child that we provide. We have a list of hours. What is the job description? What is the hours? So we go into more depth and understanding your business model and the age of your children, what is natural, what do they actually do?
Yeah.
So
And
that's,
quite frankly, child labor laws are designed to prevent you from requiring your 12-year-old to work, 15 hours in the coal mine, okay, not 5 hours a week in your office. So let's keep some perspective on this.
Mhm.
There is one final benefit of putting your children on payroll. If they misbehave, you can threaten to lay them off.
So those are, I mean, I love that stuff. It's very unique. Obviously, maybe this makes sense for some people, especially for those of us that, actually want to teach our children a little bit of the business side as they,
Mhm.
are coming into those ages where it's important to kind of see that. And then, of course, there's the passive tax benefits, potentially individualistic. Obviously, each person can explore this with you. Just a quick side note on 529s, college savings plan. Is that possible to set up real estate within that? Or is that opening up a can of worms here?
Okay.
529 plans. They're great for grandmas and grandpas who don't necessarily trust the other spouse, if you get my drift. 529 plans are specifically deducted from your children's need when they go to qualify for Pell Grants, student loans, and what have you. Depending on the state, they can be tax deductible or not.
Most states, they're not tax deductible, the contribution into a 529 plan.
They are tax deferred. However, if you do not use the money for higher education, it comes back to mom and dad with a 10% tax penalty.
Maybe better
they're
just to
okay.
set it up in the real estate and let the normal tax benefits you get, be to your advantage and use that potentially for college versus dedicating it to 529 per se.
We love Roth IRAs.
Sure.
Because Roth IRAs grow tax-free. You don't have to use it for college education, although you can. And you can go self-directed and buy real estate in a Roth IRA. I mean, teaching the kids, one of the greatest benefits a parent can have to their children is teaching them how to fish, teaching them the real estate business. And so now they put their kids on payroll. The kids get excited. They see their statement from their Roth. They could, partner up with the parent, buy the real estate. And it's such an incredible education above and beyond the tax benefits.
And that's the big picture, ultimately, is we're trying to create generational wealth and using those tax advantages to pass on. I mean, we're passing on the education. And that's the most valuable thing. So I guess, Adam, you got to put your kids to work, right? Is the long story short.
All 11 of them, Adam. All 11.
The one thing that I do want to say about the Roth is that it is not deducted on your FAFSA application like the 529 is. So it's excluded. So you can, if the kids get a scholarship and they've got, $50,000, first you have to use the 529 first. In the Roth, it's excluded. You can get the full scholarship and have the Roth either use it for higher education or defer it to retirement.
I got to say, there's something really exciting about this. You notice that we started talking about the benefits of real estate. You notice how quickly it expanded, like well into now we're doing college planning. And, I mean, it's like, for me, real estate's like the Swiss Army knife of in the financial world. There's so much you can do with this stuff. Okay?
And that wasn't even one of our bullet points. So go ahead.
I do want to ask one more thing about the tax benefits. Let's say I'm not, I don't have a tax plan with y'all or anything right now, but I do have a CPA who did my taxes for this year, and I'm looking over it to make sure that it's what I want to submit to the IRS for my taxes. What are some things that people should really look at to make sure that their CPA has properly deducted everything, in your opinion?
Well, most of the time, what the taxpayer can be responsible for is it accurate? Are the numbers actually there, and are they actually the right numbers? All the time we see tax returns where the tax advisor decided to take a shortcut and write off $40,000 on whatever it is, and the taxpayer is like, wait a minute, I only spent $32,000. That kind of thing the taxpayer is actually responsible for. However, when it comes to deductions, sometimes it's very difficult to read that. So what you really want to do is you want to take your tax return, go ahead, take advantage of the tax evaluation that we're offering to the rent to retirement community, submit your tax return. Our software program will read it over, and we will be able to tell you what you should have been able to deduct and what you will be able to deduct next year. An evaluation.
And the biggest thing there is just having proper planning. I think, Adam was asking about like right now, and that's important to look at
Yes.
that. But moving forward, it's having that offensive planning as well as a defensive side, and just educating yourself and making sure you're having the right professionals assist you with this.
Yeah, we only have a few days left before the 18th, unless somebody wants to do an extension, Adam, to go back to 2021. Most of the strategies, the guillotine comes down on December 31st. Okay.
Yeah.
So like putting your kids on payroll, Augusta roll, certain things like that, that has to be done by December 31st. Things that could be done after the fact, or like cost seg, Roth or IRA contributions up until April,
April
18th. And so what happens is that there may be a few things to look at. One of the things that we find, especially when people do their own tax returns, is the depreciation schedule is not accurate. We see that a lot.
Yeah.
So that's one of the big things that we see.
And here's a favorite one for real estate investors. This mistake is made all the time. And it's very common when people change tax preparers. Depreciation gets left off the report entirely. Now, let me explain the danger of that. The danger of that, obviously, is you miss tax deductions today. However, when you go to sell the property, IRS doesn't care whether you used it or not. They recapture the amount you should have used. It can be a very expensive mistake.
That's detrimental. And obviously furthers the point that you got to be hiring the right people and not be trying to, save a couple bucks on your preparation, because obviously the right people in the place will save you significantly more money than they're going to cost you in the short and long term.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.